The fund we're reviewing today is the Stanlib Equity Fund. Managers of that are Paul Swanson and Herman V. Vilza. Fund size almost 3 billion rand. Their inception date August 2010. TER 1.79%, and the objective is the SWIX. Let's just quickly come back to a point we made before we went to break, because I mentioned that you were bearish, but the comment there was that you're a little bit more cautious, and I think we just need to clarify that.
Yeah, I fully agree with that. I mean, it's a cautious stance. But it's trying to allocate money to, or capital to equities. The question though is, what's the right time to do it, and can you get valuations to play the game with you? At the moment, they're not playing a game with you at all, and that's what's creating this kind of disjointed effect. But that can change very, very quickly.
Look, we've got a positive undertone globally, so we actually put out a research piece, and the title was called Stay Long But Not For Long. So there is still a bit left in terms of upside, but it all depends on what's happening overseas. Don't look at the domestic fundamentals at this stage, because we are globally supported by that trend. So equity is good, bonds, I'd be a bit more nervous.
So back to the Stanlib Equity Fund. What stands out for you, Cobie?
Well, I mean, I think firstly here, what we're doing is, in the next two shows, we're actually having a look at the general equity classification and the funds that did superbly well during 2012. And now we're trying to add some context to those two funds and trying to say, well, how have they actually performed long term? And are there long term numbers at play here? And what do they literally mean for, for returns? Now, the Stanlib Equity Fund has actually been running since 2000, which is actually quite nice. So we've got a little bit of history to have a look at. Just have a look quickly at the returns on your screen there at the moment. And you'll see that you can see what the returns look like for Class R and Class A. We're following Class A at the moment, and that's obviously the total expense ratios we showed you just now. Look at those returns, 28.52 versus the benchmark of 29.09, and the sector at 21.41. So obviously having done much better than the sector. Benchmark over here is the shareholder weighted index. Over 3 years, it's 18.24 versus 17.59, but over 5 years, it's a fairly tough fund to have been invested in at about 5.10 versus 10.10. Let me just put those returns quickly for you into context. What you're seeing over here is, in the blue shaded area, is the rolling 12-month returns minus the benchmark. So when it's below the line, such as that area that you're seeing over there, that means there's been underperformance relative to the benchmark. And when it's obviously above the line, it shows outperformance. And if you want to see what the benchmark has done, that's the SWIX. That's the red line that runs through there on the rolling 12-month basis. Now, I mean, it's interesting. And I mean, Roland, maybe you want to comment about this, because there seems to be a positive correlation between what markets do and what the fund does. So when the markets do well, the fund does well. But when markets do badly, the fund seems to do badly, well, which is kind of the reverse of value, isn't it?
Well, that often can be the case with what would be called a slightly higher beta fund. So most fund managers have a low beta. In other words, they don't outperform when the market runs, and they do well when the market crashes, kind of thing. This is a bit of a reversal, and I think it's the only reason for that is that this is quite a large cap kind of fund. So large caps don't have that defensive nature, so they tend to do maybe slightly worse in a bad period and then slightly better. Especially in 2012, they've actually done exceptionally well. They've really come back, and it's because large caps, 2012 was the year of large caps. We saw some fantastic returns from really big companies, and they've got them all. I mean, they've got BHP, MTN, SAB had a fantastic year, First Rand. These are their top holdings.
Woolies had an incredible year.
They don't have much retail, so they missed that retail. They also missed Sasol, but they missed that in the right way. Sasol was a shocker, and they didn't have that. And Sasol's probably one of the most widely held shares in large cap funds. So they've actually, from a stock picking perspective, done exceptionally.
Interesting, the sector allocation though, you were mentioning the retailers, but they do have, it is skewed at this point in time towards consumer goods, just over 20% there. Financial sitting at just over 17%, basic materials sitting at 15, almost 16%, and then you run through that list. So you wonder what their thinking is this year when it comes to that consumer sector, and if they're going to upweight towards resources. Well,
we've seen in January, which hasn't been very long, a few weeks only, a huge sell-off in those consumer stocks. So let's hope, because this is out of date data or historic data, so let's hope they've managed to get out of the retail shares, because that could impair their performance a little bit. But the other shares are still doing quite well that we have on this list.
You know, if you sat at the beginning of last year and you said, okay, from a valuation perspective, I'm going to go and buy the cheapest companies I can buy. And I mean, and you try to be cognizant of quality as well. So it's both value and quality, and you try to combine those two. you did pretty poorly last year because, quite frankly, valuation didn't really mean much last year. Mid and small caps did fantastically well from a fairly decent base, and then you had retailers and a couple of other stocks that just pushed markets into heady space. So if you were forward-looking if you were forecasting earnings last year and you were pricing those into the market, then you potentially could have created some fairly decent gains out of the market. But just on a straight line valuation basis, you probably did quite badly. That's the value-based managers, kind of lagging on the back end of that on a continued, for last year. That might change this year.
Yeah. Do you think value funds are going to have a better year this year? I mean, who's to say that it can be, more of the same?
Well, value funds do badly when we're in a growth phase, and we've seen huge growth in earnings and dividends, so it's been tough as a value manager to try and buy cheap companies because they just haven't delivered. And this fund definitely doesn't have a value bias, it's more of a growth bias. These companies are storming ahead, and they got that trend a year ago and it's paid off. So I think we're going to see, if we see a global underpin to this kind of thing, we should see global companies in South Africa do quite well, the offshore companies.
Look, if you could understand, and I mean this is now forecasting, which everybody is pretty bad at as far as the market is concerned, but if you could have a look at those companies that will surprise on the upside, and where you could at least have some margin of safety, then quite frankly you could do quite well during the next 12 months.
As a value investor, is that what you're saying?
Well, no, as any investor.
Yeah.
You see, if you're a value investor, what do you buy? There are a couple of buying opportunities, that are kind of firmly into value territory. But other than that, there isn't. It's not.
I mean,
like
we could talk about construction sector right now. Those come to mind.
Yeah, quite correct. And there's some mid and smalls and some smaller large cap companies that you could potentially be looking at. They've got some inherent problems within them, but it's not necessarily widespread. Now, you can't build a whole fund out of something like that. So it's not like there's massive themes that you could look at in the market and saying, well, this is what will drive the market or versus that. So it'll be quite interesting to see how this kind of plays out as the market continues to price earnings on during the year.
Yeah, Roland. Lastly, on the asset allocation front from a geographic perspective right now, very much weighted towards South African domestic equities. If you call British American Tobacco a domestic equity, of course, earning a lot of earnings offshore, but they've got domestic equities at 79% and foreign equities at 18.5%. This, of course, historic. I wonder what they're going to do this year.
Yeah, I mean, it can be a bit misleading in the sense that they've invested in some big SABs and BTIs, which are globally diversified companies, but come up as equities, and that would be the right thing to do going forward as well. I certainly would not support domestic growth as much as I would support growth in Europe. We're seeing actually 2012 was the year of Europe in terms of crises in Europe. We're actually seeing now that Europe is looking quite good, and 2013 probably is going to be a year where we focus on America in terms of political problems, although the US financially is looking much better. Housing market, jobs are looking much better than before, but politically the concerns have now shifted back to the US.